Alright, you're probably seeing this from social media or other YouTube videos right now. Tech short squeeze incoming. Short interest at multi-year highs. Get ready for liftoff. And look, I get it. That stuff gets your blood pumping. So today we're going to break down what's actually happening with tech shorts right now. What the data really says versus what social media wants you to believe, and whether this so-called squeeze has any teeth. And hey, if you're short on time and you refuse to listen to some random cat guy on the internet, here's the one thing I need you to walk away with. There is a big difference between a short covering rally and a real short squeeze. Most of what you're seeing in the headlines right now, it points to the first one, not the second. And if you don't understand that distinction, you could end up buying someone else's exit. So, stick around. I'll show you exactly why. And real quick, if you're new here, welcome. My name is DataCat, former corporate slave. I was an analyst at a Fortune 50 company for quite some time. Honestly, I spent most of those years quietly questioning my life choices during Monday morning stand-ups. I'm not going to pretend I'm some market guru. I'm really just an introvert who traded the corporate grind for lasers and keyboards and, well, a cat that judges me while I'm not out at work but recording these videos instead. This channel's only been around about 7 months now, so yeah, we're small and still figuring things out. But my goal is simple. Give you the kind of honest, data-driven analysis I wish someone gave me when I first started investing on my own. No hype, no courses to sell you, just the numbers and what they actually mean. If that sounds like your kind of thing, a like or subscribe genuinely helps this little channel grow. That's it. That's the whole ask. My cat would thank you too, but he doesn't thank anyone. Ever. Alright, enough with that, let's get into it. So here's what's been circulating. You've got the tech sector pulling back pretty hard this month. And alongside that pullback, a narrative has taken hold, mainly on X, Reddit, the usual places, saying, short exposure is at multi-year highs, a squeeze is coming, load up. And the data points people are throwing around sound pretty alarming on the surface. Let me walk through them one by one. First, XLK, the Technology Select Sector ETF. Short interest there is reportedly around 1.8%, and people are saying that's the highest in at least 6 years. And you know what? That might be true, but, how should I say it? A 1.8% short interest is still small, like really small, even if it's a 6 or 10 year record high. That's like saying my cat is angrier than he's been in 6 years. Okay, sure, but he's still just sitting on the couch. He's not exactly flipping the table. Second, Microsoft. The claim going around is that investors shorted over 58 million shares last Wednesday, about 0.8% of its free float, near the high end of its 5-year range. Now, here's where you need to be careful. That 58 million number, it lines up well with total short interest as of late January 2026. But the framing, investors shorted 58 million shares on Wednesday, is almost certainly confusing two very different things. Short interest, which is the total stock of open short positions, versus short sale volume, which is the flow on a given day. And a huge chunk of daily short sale volume is just market makers and hedgers doing their thing. It's not some army of bears piling in with a directional bet. So Microsoft at 0.8% short interest, that's not squeeze territory, not even close. Third, Salesforce, ticker CRM. About 18 million shares sold short, roughly 1.9% of its free float, which apparently puts it at the 100th percentile over the last few years. Okay, that sounds dramatic, but again, 1.9%. It's elevated for Salesforce, sure, but in the grand scheme of squeeze mechanics, it's still a modest number. Now, you might be running out of patience and yelling at me, why am I making this video then? Because there's one that actually caught my eye. IGV, the iShares Expanded Tech Software Sector ETF. This is the software basket, and it holds names you definitely know. The top 3 holdings are Microsoft, Palantir, and Oracle. Then we got Salesforce, Intuit, AppLovin, Adobe, Palo Alto Networks, CrowdStrike, and ServiceNow, basically the who's who of software. Reuters, citing Ortex data, reported that short interest in IGV spiked to around 19% around mid-February, near the highest on record. And yeah, this time, that is a genuinely elevated number. That's not nothing. But, and I need you to hear this part before we move on. There are 2 critical caveats that the viral post conveniently leave out. Caveat number 1. Ortex estimates short interest using stock loan data. It's an estimate, not gospel. The official exchange and FINRA short interest data comes out with a lag and can look materially different. Aggregators like Fintel show days to cover for IGV recently sitting around 1 to 2 days. And days to cover matters a lot for squeeze mechanics. If shorts can cover their entire position in a day or 2 of normal volume, there's no bottleneck. There's no I can't get out panic. It's like, imagine my cat knocks a glass off the table. If she only pushed it to the edge, you can just grab it. That's days to cover of 1. Now if she pushed it off a 10-story building, different situation. But we're on the ground floor here. Caveat number 2, and this one is huge. ETFs don't squeeze like individual stocks. And I really need you to internalize this because it changes the entire calculus. With a single name stock, there's a fixed number of shares. If shorts need to buy and there aren't enough sellers, price gets squeezed up violently. But ETFs have this mechanism called the creation-redemption process. Authorized participants, big institutional players, can literally create new shares of the ETF. So shares short can grow without creating the same kind of true scarcity that drives a classic squeeze in a low-float stock. The plumbing is just different. So yeah, IGV has crowded positioning, that's real. Oh yeah, speaking of which, if you still haven't watched the power and impact about crowded positioning, I'd recommend you checking out one of my videos at the homepage. But crowded positioning in an ETF with active creation redemption and low days to cover is not the same setup as, say, GameStop in January 2021. Not even in the same universe. Okay, so let me give you the framework I actually use when I see these kinds of headlines. Because squeeze gets thrown around so loosely that it's basically lost all meaning. It's like calling every rainy day a hurricane. There are really two distinct events people mash together. Event A, a classic short squeeze. This is the forced, disorderly, violent kind. For this to happen, you typically need several things firing at once. High short interest and high days to cover. Rising borrow costs with high utilization or even share recalls. A catalyst that gaps the price up hard. And often an option structure that creates what's called a gamma squeeze, where market makers hedging their positions amplify the move. For IGV right now, despite that 19% short interest estimate, borrow fees are sitting around 0.89%. That's cheap. That tells you IGV is not hard to borrow. Shorts are not under funding stress. They're not being squeezed out by cost. They can sit in their positions comfortably. So the probability of a true disorderly squeeze, the kind where shorts literally cannot locate shares, is low right now. Event B, a short covering rally. This is way more common and honestly way more tradable. This happens when shorts who are already in profit decide to take some risk off the table. Maybe a good earnings print drops, maybe there's a macro relief catalyst, maybe the AI narrative shifts again, they don't have to cover, they choose to. And when a lot of them choose to at the same time in a crowded name, you get a sharp, fast move up. For IGV, given the crowded positioning, a short covering rally is meaningfully plausible. But you need to understand, that's a trade, not a thesis. It's fast money, not a trend reversal. And if you go in thinking it's the beginning of a new bull run, and it's actually just shorts taking profits, you become the exit liquidity. My cat doesn't feel sorry for exit liquidity, by the way. He only feels sorry when his food bowl is empty. Sorry, can't help it. Now let's analyze this matter deeper, and let me walk you through the technicals as of last Friday. Because the price action tells a really clear story if you know how to read it. IGV is sitting at $82.77. That's about 7.2% below its 20-day EMA, 17.1% below its 50-day SMA, and 22.4% below its 200-day. Every single major moving average is above price and sloping down. None of the last 20 trading sessions closed above any of those averages. This is a clean downtrend. So right off the bat, any upside move from here is still counter-trend. It's mean reversion, not a new trend, until price reclaims at least that 20-day EMA around $89 and starts printing higher highs and higher lows. That hasn't happened yet. Now here's the sequence that played out. From February 2nd to the 5th, you got 4 consecutive down days, about 11% total decline. Volume on the 4th and 5th was enormous, around 45 million shares each day. On February 5th, IGV hit a low of $79.27. RSI collapsed to 14.8. MFI hit 11.8. That's textbook capitulation. The panic selling, the get me out at any price behavior. Then February 6th, sharp bounce, up 3.5% on about 38.6 million shares, with a gap up of 2.38%. Classic short covering plus dip buying. But and this is the key part, that rebound attempt failed. By February 10th, price tagged $85.41, basically kissing the Fibonacci retracement level at 85.27. And then sellers showed up. February 11th, down 2.5%. February 12th, down another 2.73%, both on heavy volume. 34.7 million and 30.6 million shares. The overhead supply defended that level aggressively. Okay, I know I'm throwing out a lot of confusing numbers, bad habits. But what does that tell you? It tells you this is not behaving like shorts are trapped and being forced to run. It's behaving like shorts covered some into the flush, then re-established positions when price bounced to the obvious resistance. And that's a confident short selling, not panicked short covering. Now, the constructive part. On February 12th, the low was 79.71. That did not break the February 5th low of 79.27. And February 13th bounced 2.24% with a small gap closing near the highs. So you've got an attempted basing pattern forming above $79 to $80. That's something. But it's a base until it breaks through the ceiling. It's not a launch pad yet. Now the current volume is up about 1.28 times the 20-day average. But here's the thing. The up volume to down volume ratio over the last 10 sessions shows that sellers still dominate on net. Rising volume with sellers in control is not accumulation. It's distribution with occasional bounces. It's like my cat purring while he slowly pushes your coffee cup toward the edge of the desk. Looks friendly, but you know what I mean. So let me give you my honest read on where this goes over the next 1 to 3 weeks. Scenario 1, and I think this is the most likely, choppy base between $79 and $85. Price just grinds sideways, testing support, failing at resistance until something forces a resolution. This is the boring outcome, which means it's probably what happens. Scenario 2, short covering rally toward around $90. This becomes plausible if $85.30 breaks and holds with conviction, meaning on volume with follow-through, not just a wick above it. If that happens, you could see short scramble to cover, and a fast move toward the 20-day EMA around 89 to 90 makes sense. This is the squeeze-ish path. Notice I said ish. Scenario 3. Breakdown to retest around $76.70. This becomes likely if 79 to 80 fails on a closing basis. And honestly, with the overall downtrend still firmly intact and sellers showing up at every bounce, this is not off the table. So look, is short interest elevated in tech right now? Yes. Is IGV crowded on the short side? According to Reuters and Ortex, which is usually credible, yes, genuinely so. But does that automatically mean a squeeze is coming? No. The borrow fees are low, days to cover is short. The ETF structure allows share creation that bleeds off scarcity pressure. And the chart is still in a downtrend with sellers defending every bounce. What you should actually be watching for. Can IGV hold 79 to 80? And can it break through 85.30 with authority? If both of those happen, then you have a real short covering setup. Until then, the squeeze narrative is mostly content creators doing what content creators do. And I say that as a content creator who is literally a cat on the internet. The data doesn't lie, but the framing absolutely can. Be careful out there. If you found this useful, a like or subscribe goes a long way for a tiny channel like this. No courses, no Discord pumps, just a former corporate analyst and an extremely judgmental cat trying to make sense of the market. Alright, thanks for watching. DataCat out, and I'll see you in the next one.